Hello and welcome. Today I'll be discussing the Nutmeg investment team's view on inflation. While we may be past the peak in inflation that we saw in 2022, lingering price rises continue to be a concern for investors and central banks alike. 4 months ago, markets were expecting up to 7 interest rate cuts from each of the 3 major central banks: the Federal Reserve, the Bank of England, and the European Central Bank. Despite inflation slowing down over a year ago, we have seen markets alter their expectations on the back of stronger growth in the US and stickier inflation across developed economies. This stickiness comes from stubborn inflation in the services sector, which, depending on the economy, includes housing costs and, importantly, the impact of wage growth. This is especially of note for the UK, where wage growth has been strong, coming in at 6% higher compared to a year ago. As a result, at the time of recording, and on the back of stronger inflation data for March, markets are expecting a single interest rate cut of 0.25% in 2024 from both the Federal Reserve and the Bank of England. You note that I didn't mention the Eurozone or the European Central Bank. The ECB uses a different approach in setting interest rates compared to its British and American counterparts, who predominantly focus on recent inflation prints and near-term forecasts. ECB looks forward a couple of years as its guide, and this medium-term outlook has inflation back at 2%, which happens to be the ECB's target rate. It also has to consider that growth in the bloc has been weak for most of the past year. This means that the ECB is most likely to cut interest rates first in June by 0.25%, with 2 more cuts being priced in for the remainder of the year. So what impact could this have for investors? We could potentially see a weaker euro compared to the dollar and the pound. If the euro is weaker, it makes buying goods from the Eurozone more attractive. This is good for the Eurozone given how export-dependent the economy is. In the UK, lingering inflation could mean that the drop in mortgage rates that many were expecting to occur has been pushed further into 2025. Higher rates near term provides additional support for the pound, notably against the euro. However, this may act as headwind to FTSE 100 given the dominance of international earnings in the index. That being said, any downward surprise in wage growth and inflation will be welcomed by markets as the Bank of England is looking for a reason to deliver interest rate cuts. Thanks for watching.